Hello, good morning, everyone. Welcome to another Wealth Coffee Chat. Good to see a few of you up and at it on this fabulous Friday. September's almost over, folks. What do we got? October, November, December. This year has gone by so fast. So fast. There you go. Anyway, hello, Deb. Good morning. Good to see you, Deb. A few of you up and at it. Chris, all the way from Kalgoorlie, mate. I hope it's all... Say hello to a few of my mates over there while you're there. Say hello to Lindsay. Saucy. Is that how you say it? I don't know. Good morning. Hopefully I got that enunciation or pronunciation close. David, good morning to you. Tim's in the house. How you going, Tim? Good to see you, folks. Welcome along. Thanks for joining. Another Wealth Coffee Chat, as we do each morning around about 10 past 8. But yesterday didn't get a chance to hang out with you guys in the morning. I was catching up with Andy and Deb, actually, and a few business owners. We've got a bit of a business owner program going on right now, which is we're calling the On-Ramp. Business owners are a little bit different when it comes to getting prepared for finance and buying investments. So we're doing something specialized for business owners. So we did a bit of that yesterday. And all right. Thanks. I'll practice off screen. That's what I'll do. Sisha. Okay. All right. I'll thank you for being a good sport. Morning, Brendan. All right. Now listen. What else has been going on? Yeah, weekend's coming up. Who are you backing in the grand finals? Hey, listen, Queensland's kicking ass. I don't know if anyone's into sport. Recently, I've got back into sport because my son has got into sport. He's 13 now, and my last one at home. The other two almost flown the coop, but yeah, back into the rugby league. Yeah, the Knights. Yep. Yeah, okay. Oh, boo, Deb. The Titans versus the Knights up here in Queensland, I think. Oh, is it? No, it's down in Sydney. So yeah, so we got Queenslanders representing, which is pretty interesting. So the Queenslanders, the Brisbane Bears, I think it is. Is it the Brisbane Bears? No, not Brisbane Bears. Anyway, in the AFL. The Brisbane Lions, that's right. Sorry, not my sport. Brisbane Lions in the final. We got the Broncos, Queensland in the final for the the rugby league and the men and the women, the Titans versus the Knights, and the Queensland team, I think it was the Brisbane Bears, won the VFL, the Victorian Football League. Anyway, too much sport for some. I hear you. I hear you, Jason. Get on with the morning. Get on with what we're talking about this morning. Well, welcome along anyway. There you go. Bit of a rambling start to our Wealth Coffee Chat, but thanks for joining, folks. Good to see you here. Today, I was going to talk about something that we were talking about yesterday, Deb and I actually, matter of fact, and Andy, we talk about the idea of certain spaces as investors, as aware, self-motivated, financially free seeking individuals. Well, where's a good place to store in our money? Storage structures, efficient places. And when we talk about efficiency, what do we mean by efficiency? Thanks, Luke. What do we mean by efficiency? Well, it's pretty important to appreciate and understand this stuff when it comes to talking about our money, because there's a couple of dimensions to it when we have it, right? When we have it, when we're going to take care of it. Anyway, let's talk about it. Let's talk about these kind of three common things that I see out there in the world of investing. Let's see if I can get my pencil working. There we go. All right. There we go. Okay. All right, we're away. Three common things. What's the most common place, folks? Tell me in the chat. What's the most common place? And I don't even know if that's great English, but what is the most common place that most people will store their money? 90%, maybe even more. Where do people store their money? Let's say they've gathered some cash, and, over and above our expenses, over and above our cost of living, and we've got some excess, we've got some spare cash and capital. Where do most people put that? Because they think it's safe, it's a good return, it's guaranteed, et cetera, et cetera. Now, you guys, Luke and Tim, you guys are smart cats. You're investors. You know what's going on. But yep. That's where we should be, under the mattress. I do know some people who still get some cash out, Chris. And, arguably, there may be a small argument for a little bit of cash floating around one way or another. But anyway, that's not what today's talk about. All right. David talked about it. Most people think, all right, I'll put it in the bank. I'll put it in the bank. Now, and more importantly, in a savings account. Now, the term deposit, most people don't use those term deposits, but that is kind of an area or a place where investors might go, okay, well, I'll put in a term deposit, right? They put it in a savings account. Now, tell me, and you guys know this, and I won't labor on about it, but what return do you get in a savings account? Why do people put money in a savings account or a bank account? I call it a spendings account, or more a losing account. A losing account. Why is it a losing account? Well, listen, inflation is the thing that we have to understand, not in its entirety. We don't need to be economists, crying out loud. You just got to understand that inflation kicks along, right? Kicks along at a certain yeah, that's a technical term, Chris. I might borrow that one from you. 4/5 of F all. All right, exactly. Inflation goes up. Let's say inflation goes up at 3%, and you get let's just say, I'll be conservative, you get 1% on your cash in the bank account. So technically, you lost your cash devalued 2%. Your ability to buy things with that cash next year compared to this year went down. Right? We don't get taught this. Many of us don't really comprehend it for most of our lives. We're like, you have to, your money and your wealth and your assets, their job over the medium term, and certainly with cash, you got to beat inflation, folks. If you're not beating inflation, you're going backwards. You're going backwards, especially with cash and money, right? So 90% of people put it in the bank. They put it in a savings account. Now, maybe in a term deposit, you might get a little bit more, right? You might get something else, okay? And as we go along, right? So then, where do people put? Where else do people put their money? And I'm just going to do 5% and 5%. It's probably more than that, but their cash. Now, the next smart place to put some cash, an easy place to put some cash and get a return. And it's not necessarily a return, but it's making your cash work better. It is in your offset account for sure. For sure, folks. Offset account. If your interest rate is 7%, and you've got, let's say, 20 grand, 100 grand, 400 grand, whatever it is, that's 7% saved, folks. That's damn fine. Now, that gets my tick of approval. Certainly, every cent you've got should be sitting in that offset account until you can deploy it into something better, ladies and gents, because the offset account is not growing. It's not producing an income directly from its asset base. It's not leveraged. It's not invested, but it's certainly better than letting it sit in the damn bank's account. And you get nothing out of it. Your cash devalues, goes backwards, okay? And then the last part, investments, right? Investments. We want to deploy our cash actually into investments. And I like the idea of getting some leverage, which means let's say you've got $1, you turn it into $5 worth of property. I like property. You guys know that. But you can buy other assets totally for sure, which, in the form of shares and businesses and other things, right? Leverage, you get an income, you get some growth, and often you can get some tax advantages, all right? Some tax treatments, all right? Now, a lot of people go, taxes, tax deductions, not a good idea. Like, they don't know what they're talking about. They're full of shit, right? Now, they're not a reason to invest, okay? Not a reason to invest, but they certainly help all of us when it comes to investing. It's like the idea of borrowing's not a good idea. Save up for cash. Now, yes, that completely works. But I can tell you, if you borrow in a smart way, use some of the tax advantages in a smart way, the income and growth is accelerated. It's multiplied, okay? Now, in circumstances where you go, I'll buy that because you get tax deductions, that's stupid. On the flip side, someone say, don't worry about that, tax deductions and all that sort of stuff is not a good idea. Like, again, that's stupid as well. So they're both stupid. Anyway, drop my pen. Stay on track, Jason. What's the point of this conversation, folks? Well, today I wanted to talk to you guys about a couple of things. You guys have seen me talk about this before. There's a few places where we can get tax-free advantages in the world of investing. One is your principal place of residence. Your home is capital gains tax-free, folks. And we talk about the PPR upgrade strategy. Super, okay? And that I want to mention that one today. $1.9 million worth of assets and income that you can have with your super tax-free into the future in retirement phase. Right? That's damn fine. That's sweet. Now, a business sale for business owners, you got to qualify with certain things, but you can have well over $2 million worth of tax-free capital gain tax-free as a business owner, which can include a commercial property, and I've talked about that before. And what's the other one? Well, you can do something tax-free, and I don't know if everyone realizes this, but the first 18,000, I think it's 18,500, is tax-free to you. Okay, the first $18,500 that you earn is tax-free, folks. Dun, dun, dun. Now, the point of today's conversation, which I wanted to sort of talk about, is this one. Now, for you, tell me in the chat who thinks it would be a smart idea to store some of your wealth for the future, up to 1.9 million of it, in a place where you can get tax-free income indexed for the rest of your life. Who would like the idea of creating it's 110,000 a year tax-free and indexing over time? Who would like that? And put a yes in the chat just to play along with me, because if you add your tax-free portion plus the portion of super at a 5% return, that gives you about 110,000. Yep, me says Luke, for sure. Now, the issue, what is the challenge here, though? What's the challenge? And this is really what I wanted to sort of talk about today. Yeah, good questions, Chris. They're good questions. Because the challenge is, can you transfer a property into SMSF? Do you have to sell it, move the cash? You can't transfer the property, Chris. Well, there is one property you can transfer if it all qualifies and works out. Does anyone know what it is? Put that one in the chat. There is one type of property you can transfer into super from outside of your super. Does anyone know what it is? With residential, Chris, I'm giving it away now. With a residential property, you have to sell it. You have to take the cash, and it's actually part of the strategy. It's a business real property, Tim. You're dead right. A commercial property that you use for business. Yep, that's right, Chris. With your residential property, and folks, obviously this is not individual financial advice, for crying out loud. This is understanding what's going on. You have to sell well, one way of doing it is to sell a residential property and then contribute the proceeds using a number of mechanisms, if they're available to you, into your super. And your super's got to be below a certain level, $500,000. So, Chris, there's a strategy around this, is what I'm saying, folks. The problem, the issue, the challenge, let's talk about the issue, the challenge, is that most of us, right? Most of us, and I'll chuck this up here now. Most of us, if you, I've got a little calculator. There's another calculator you could go and have a look at, which is the Money Smart calculator here as well. Money Smart do some great calculators, but this one here for me is a little bit more. So let's say you had $200,000 in your super, and I've just put 2020 here, right? Maybe we'll make that a smidge bigger. Let's see. That a bit bigger. There we go. Yeah, it's bloody, you're dead right. This is exactly right, right? It's bloody hard to get money into super, and enough money, folks, okay? Now, this is sort of one person here, sort of get 200,000 in your super. Oh, get rid of that. 2020, that was the case. Your investments in super might be getting you 5% growth. $500 per week income is the contribution to super. 500 times 52 is about 25,000 or whatever. That's the maximum contribution, right? And then you get a bit of income growth, okay? So now in 15 years' time, if you are, 50 right now, and that's a very common super balance for people at 50, 40 and 50. You can put a bit more, you can put a bit less. But, have a look at this, ladies and gents, folks. At the top here, the market value is only 415 grand. Now, plus or minus, if you get a better return or a worse return, at the end of the day, what is happening right now is many of us have got the, yeah, exactly, Jeff, so many of us have got an opportunity to get some, an opportunity where we could store some of our wealth and our capital in a place where it's very effective for us to self-fund and be financially free in the future. But it's damn difficult to get the money there. Now, pure cash contributions won't do it unless you start at age 25, right? So how do you do it? What do we do? Well, I'm a bit biased on this sort of stuff. So I'm going to show you. So have a look at the top here, folks. Market value. You need to have a bit of dough in super. So, let's put 300K there. Even 300K starting point, you're still only going to get to 6.2 or something like that. So let's say, I'm going to say we're going to buy an investment property. You buy an investment property, whack that in your super, 2023. And then, even if you change that to, 700,000, change that to 700. Check it out, folks, right? Put some growth in there, some income growth, so rent per week, loan amount. We even dropped the loan amount down to 500,000 because you've got to put 200 grand in there. And have a look at that. Have a look at that. The value in your super now is $2 million. Ta-da, 1.9 million. Equity, which is the debt-free portion, you let that run a little bit longer and it'll pay itself off. But 1.63. Happy days, right? So that's fantastic, Chris. Yep. So what's the point of our conversation this morning? For many of us, we've actually got opportunities right in front of us to be very efficient if we're smart about our strategy and what we're up to, okay? Where can we be efficient? You guys know this. Your home, Prince Place of Residence, it's a great place of capital gains tax-free storage for the future, but it gives you low to no benefit now when it comes to income or tax deductions, okay? So keep that in mind. And liquidity and that, if you get stuck, do you want to sell your home and, free things up? Probably not, right? So super. If you haven't already worked out a way to maximum contribute into your super, doing some budget and that sort of stuff, go and see a great financial planner and get a plan around that stuff. One property and it gives me it annoys me to say it, but it's a very effective strategy. If you're sub 500,000 and you've got an investment property outside of super, setting up a plan to sell that, take the gain and put it into super, and then repurchase in super it could be a smart way of doing it, getting money into super, all right? Check in with your financial planner and your advisors on that one as we go. Anyway, that make sense? The point is, team, there are places and spaces to store money, and as investors, we want to make sure we're storing it in effective places, very effective places. Anyway, there you go. That's it. That's it from me today. Wealth Coffee Chat done and dusted, folks. Great to see you here. Thanks for joining. And join me next week for another catch-up about 10 past 8 as we go along. That's it, I think. I think we'll just say done and dusted. Adios, amigos. All right, folks, that's it. Take care. Thanks for joining. Bye for now.